Gold hit $5,000 an ounce, and silver crossed 103. And if you think this is just another speculative bubble about to pop, you might want to reconsider. Because what's happening right now in the precious metals market isn't about technical charts or retail investors getting greedy, it's about something much bigger. We're watching the largest physical delivery of gold and silver in history, month after month for over a year now. And that tells us something profound is shifting in the global monetary system. My name is Khan, and I've spent 35 years in the precious metals industry watching markets move, studying central bank behavior, and trying to understand what really drives the price of gold and silver. And if you want more deep dives like this on what's actually happening behind the headlines, make sure to hit that subscribe button because this channel breaks down the financial shifts that mainstream media won't touch. Here's the thing most people don't understand. Gold and silver have never been allowed to find their true price. Ever. Going all the way back to the London gold pool, there's been suppression through paper contracts, but now, delivery is overwhelming the ability to suppress with paper. And that changes everything. Why this is not a bubble. Let me address the elephant in the room. Some very successful investors are calling this a bubble. And look, short-term caution, always smart when a market moves this fast. But calling this a bubble, I think that fundamentally misunderstands what we're witnessing. Here's why this is different. Less than 1% of contracts on COMEX or LBMA ever stood for delivery in the past. Now, we're seeing record delivery month after record month for 16 straight months since the 2024 election cycle. In December alone, 65 million ounces of silver were delivered off COMEX. Let me put that in perspective. A mint box of Silver Eagles is 500 ounces and weighs 42 pounds. Who's buying 65 million ounces? But it's been between 40 and 60 million ounces every single month. This isn't technical analysis. This isn't what markets used to be. The dollar was always the beacon of trust. Now, the dollar isn't trusted anymore. Neither are our institutions, our judicial system, our electoral system, our immigration system. Gold and silver are reflecting that loss of trust through physical delivery. The biggest, most well-informed players in the world continue to stand for delivery at levels no one has ever seen before. And retail? The retail public wouldn't know a gold coin if it fell on their foot. I live in a country club filled with very well-heeled, successful people, and maybe 5 or 6 of them have bought gold and silver from me. These are wealthy, intelligent people who still think this is overbought. They believe what the technicals say. They trust the old playbook. If this room at the Vancouver Resource Investment Conference was filled with people who'd never been to a place like this before, people who don't follow mining stocks or precious metals, then maybe I'd agree we're near a top. But we're not even close. The public hasn't caught on yet. This is not mainstream. So no, we're a long ways away from a bubble. Could we see a correction? Sure. Doesn't change my long-term view. Record COMEX deliveries and what they mean. So let's talk about what's actually happening with supply and demand at the institutional level. In December, we saw roughly 65 million ounces delivered on COMEX. But who's doing this? Who has the capital and the logistics to take delivery of that much physical silver? And it gets even more interesting when you look at London. David Jensen, one of the best analysts in the space, says the LBMA has 2 billion ounces in outstanding spot contracts backed by only 140 million ounces of actual metal. Think about that. 2 billion ounces of claims, 140 million ounces of actual silver. What could possibly go wrong if everyone stands for delivery? That's a 14-to-1 leverage ratio. That's a massive problem waiting to happen. Now here's where it gets wild. In 2011, when silver started rallying, the exchanges killed it by raising margin requirements. They forced over-leveraged traders to liquidate, and selling begat selling begat selling. The rally died. But this time, they raised margins twice in December, once right before Christmas and once right after. On Christmas Day, you needed $21,000 in your margin account to hedge one 5,000-ounce silver contract. The next day, $27,000. Now it's over $40,000. That shakes weak hands off the tree. Refineries won't even take new business right now because the price is moving up so fast they're getting margin called on their hedge positions. If they have $30 million in inventory they need to refine, which takes weeks to turn scrap or doré into refined product, they have to short $30 million on COMEX to stay market neutral. But silver's moving up so fast that even the refineries are getting squeezed. And yet, what happened? December had the largest delivery in COMEX history because the people standing for delivery, the central banks, the sovereign wealth funds, the biggest institutions, they don't use margin. They don't care about margin hikes. To them, it's a subsidy. They say thank you very much and scoop it up. Things are changing. The old tools that used to control this market aren't working anymore. Silver becomes a strategic mineral. And then the US government steps in and does something remarkable. After all these record imports, they declare silver a critical mineral. Within 90 days, they're putting a state-sponsored price floor underneath all critical minerals. Why? To incentivize domestic mining. See, most of the big silver deposits that were easy to find, what's called epithermal deposits near the surface, those were found forever ago. Now you've got to dig deeper. Most silver today comes as a byproduct of copper, lead, and zinc mining. The all-in sustaining cost at that level is probably around $40 an ounce. So if you put a high enough price floor underneath it, you incentivize domestic mining. And now they're proposing a strategic stockpile. You can see these things happening in real time. But the mainstream doesn't talk about it. You've got to listen to so-called conspiracy theorists like us. Or maybe we're just seeing things a little more clearly than the masses. The dollar is what's really collapsing. Now people always said, be careful what you wish for. At $5,000 gold and $100 silver, the world is burning. But honestly, I don't think the world is burning. What's burning is the dollar bills we call money. Paper currencies have the sustaining power of a melting ice cube. Did gold and silver really go higher, or did the dollar just fall further? When you're creating $1 trillion in debt every 100 days, and by the way, 1 trillion seconds ago was 31,788 years ago, just to give you perspective. When the world no longer trusts dollars, no longer trusts treasuries, no longer trusts our institutions, what's the incentive to hold treasuries or dollars? There isn't one. That's why we're seeing de-dollarization. That's why we're seeing commodities replacing treasuries and central bank reserves. That's why the dollar is losing purchasing power. The world is always burning somewhere, but not in the apocalyptic way people imagined at $5,000 gold. This is about currency debasement, pure and simple, why the public isn't in yet. Here's the other thing. We're nowhere near the blow-off top that signals a bubble. Elliott wave theory measures the emotions of the public, the herd psychology that swings from greed to irrational exuberance to fear to panic. Right now, the public isn't even in the game yet. We're a long way from retail investors pouring into metals out of fear or FOMO. The people at conferences like this in Vancouver, we're the pimple on the elephant's ass. This isn't the masses. The masses are out there and they haven't even started to run through the door yet. The big money sees it, they're pre-positioning. But we're not anywhere near that retail blow-off top because the public is simply not participating. And you know what's funny? Goldman Sachs just raised their year-end gold target to $5,400 because they're finally seeing private investors start to come in. The difference between us and Goldman Sachs is we've been saying this forever, and they keep changing their target. It's a moving target. First it was $2,000, then $2,400, then $3,000, then $3,100, and they keep going higher and higher. At some point, it would be nice if they just said, we were wrong. Look at last year. The S&P 500 was up under 20% in the midst of the greatest tech boom ever. Silver was up 150%, 7 times the S&P return. Gold was up almost 80%, 4 times the S&P. Where are the financial advisors who said, don't buy that stuff, it pays no interest? They can't admit they were wrong, but they have been wrong. And the people who separated themselves from the masses have been right. Even Morgan Stanley's chief investment officer came out and said the 60-40 stock bond portfolio that we've used for 50 years is broken. His advice? Sell half your bonds and put it into gold. That's coming from the top. But it hasn't filtered down yet. I have an accountant buddy at Morgan Stanley, and when I asked him if he knew his own CIO said to sell bonds and buy gold, he had no idea. The big money positions before the masses. They'll get the message eventually, but long after the big money is already sitting comfortably. Now here's where things get really interesting, and this is where I think most people, even sophisticated investors, are missing the bigger picture. This administration's goal is to shed the reserve currency status. I know that sounds crazy, but hear me out. There's an economic concept called Triffin's dilemma. It says you will never have a positive trade surplus if you're the reserve currency. Vice President Vance has talked about it. Even Jared Bernstein, the former chief economist for the Biden administration, wrote a report called Dethrone King Dollar, advocating for losing reserve status. And there are mechanisms already in place. The Genius Act says that by January 1st of next year, anytime money moves digitally, it will move via stablecoin. And that stablecoin has to be pegged to treasuries with 90-day maturity or less. The interest isn't transferable to you or me. The issuer keeps it. And what has Tether been doing with all that interest? They now hold $14 billion in gold, the largest stockpile in the world outside of central banks. Judy Shelton, who I've spoken with twice, said the speculation is that on July 4th of this year, the 250th anniversary of the country, they might peg the back end of the bond market to gold. Think about what that means. Zero coupon bonds redeemable in gold. You bring back manufacturing at zero upfront borrowing cost because you pay it back in gold down the road. So you have the Genius Act on the front end pushing interest into gold, which pushes the price up and depresses the dollar. And if they back the long end of the bond market with gold, you're talking about a revaluation. James Rickards says $24,000 gold. Van Eck just came out and said if the dollar loses reserve status and gold replaces it, they see gold going to $180,000. Imagine you sell a 20-year bond redeemable in $100 million worth of gold. At $5,000 an ounce, that's 20,000 ounces. But at $180,000 an ounce, you're giving away 300 times less. The dollar gets massively devalued, and you can bring back manufacturing at zero upfront cost. That's what the whole world has done to us for decades. They sold us goods with devalued currencies. Now we're doing the same thing. I think we're entering a new monetary system where gold is replacing treasuries in many respects. And if that's true, then old school technical analysis doesn't work anymore. We're not in a bubble, we're in a paradigm shift. And what's China doing while all this is happening? They're setting the stage for BRICS and what they're calling internationalization of the yuan. Though really, it's about building a gold-backed settlement system. Their digital yuan is now immediately convertible into gold without going through dollars, via the Shanghai Metals Exchange. Here's how it works. China buys oil using mBridge or CIPS, cross-border payment systems free from SWIFT interference. They pay in digital yuan. Saudi Arabia receives digital yuan but doesn't want to hold it, so they convert it to gold through the Shanghai Exchange and take delivery out of Hong Kong. And now China is expanding that system. They just completed vault number 2 in Saudi Arabia. They're building vaults throughout the Belt and Road, Asia, Africa, South America. You trade in local currencies, strengthening your own ecosystems instead of the US dollar system, and you settle balances in gold deliverable through multi-jurisdictional vaults. And here's the kicker. China just signed up the ASEAN countries, 800 million people, 30% of global GDP, and they're all settling trades across CIPS or mBridge. These trades used to be in dollars, now they're not. That chips away at both dollar settlements and treasury demand, because countries used to hold excess dollars in treasuries to earn yield. Now they're buying gold instead. Over the last 25 years, gold has doubled the performance of the 10-year treasury. But look at the last 2 or 3 years. 2 years ago, gold was up 40%. The 10-year up 4.5%. Last year, gold up 80%. The 10-year up 4%. And gold can't be sanctioned. If you don't allow yourself to think outside the box, you're going to be a victim. You have to see what's happening. And the fact is, you won't see this on mainstream media. Look, I'm not a fortune teller. I can't tell you exactly where gold and silver will be 6 months from now. But if I had to guess, I'd say gold hits $6,500, maybe $7,000 by mid-year. Jeff Christian, who used to distribute for the US Mint, says $7,000 to $7,500 before we see a slowdown. And silver? I wouldn't be surprised to see $175, probably much higher by year end. But more than the price, what matters is understanding what's driving this. We're broke. We're insolvent. We're uneducated as a nation. 60% of the country reads below a 6th grade level. We're $200 trillion in debt when you add Medicare, Medicaid, Social Security, and pensions. We don't make anything. And AI is about to kneecap millions of entry-level and white-collar jobs. We cannot be reliant on the rest of the world for everything we need, from aspirin to aircraft parts. So we're reshoring manufacturing. And to do that, we have to shed reserve status. We have to let the dollar collapse against rising gold. And we have to bring manufacturing back at zero upfront borrowing costs by pegging it to gold through zero coupon bonds. That's the play. That's what I believe is happening. Maybe I'm wrong. Maybe I'm seeing patterns that aren't there. But I've been talking about BRICS de-dollarization and gold-backed settlement systems for years, and now everyone is. So maybe I'm onto something. Or maybe I just have the courage to say what I believe. Either way, this isn't a bubble. This is a new monetary system being born. And if you're still thinking in the old paradigm, you're going to miss it.